Okay, how to pay for your car. There's broadly 3 ways to pay for your car. Or there's actually probably 2 ways to pay for your car. And then there's kind of some subcategories. But literally, I pay cash, I've got money in my account, I transfer that to the person or the car dealership. You can get a loan. And by loan, I mean personal loan, a car loan, could be a family loan, any type of loan. Dealership finance, which is also a loan. You might have a mortgage and you might you might go to your mortgage broker and do a refinance. And, if you wanted to buy a $30,000 car, you get them to do a $30,000 split on the mortgage. And then it's its own $30,000 mortgage. Or there is a novated lease or a chattel mortgage, which is more if you're self-employed and have your business and you want to buy some work finance. Often the chattel mortgage is the method that is favourable, or a novated lease if you are doing some type of leasing arrangement and salary packaging. But just on this, I'll just draw it here. I'm just drawing an XY axis. So if we, at the bottom left, we'll say that, the dollar amount on the bottom axis, and then the side axis would be the interest rate. So generally speaking, as we go up this curve, the cheapest interest rate would literally be cash, because you're not borrowing money, you've got cash. And you could even think, well, I'm renting, I don't have a mortgage, because I think that, the mortgage does enter the chat. If you do have a mortgage, a home mortgage, and, we can talk about that. So we go cash, and then it could be some dealership finance, or your mortgage rates, or the lease rates could be lower interest rates. A personal loan would then be a higher interest rate, and then, car loan, then a personal loan up the top. So there is a spectrum when it comes to loans, because it's all got to do with the security. But I will say, more times than not, the interest rate isn't actually your problem. Your problem is you bought too much car and you've got to pay the capital back. So my general rules of thumb, if we are looking at getting a loan, would be as follows. A 20% deposit into the car. That's right. Why do I say that? I'll get to that. I want you to keep repayments at less than 1% of gross income on a monthly basis. I'll explain that because it's a bit tricky and it's hard, but it's just another little guide. I don't want you to have more than a 4-year term, and I don't want you to have a balloon payment. And a balloon payment is at the end of the term. You have to effectively pay, sell the car and pay the remaining loan back, or get the money from elsewhere and pay the balloon off. Now, I've got an asterisk next to that because if you're a small business owner or a business, sometimes the balloon is helpful in keeping the monthly repayments lower, because it's effectively works a little bit more like an interest-only loan for some of it internally. And then if you're using the vehicles a lot and you're turning them over a lot, that it could be a way to do that. The reason I say the 20% deposit, if it was a $20,000 car, I want you to see if you can put up to $4,000 into the car. A couple of reasons why. Because cars go down in value, this would ensure that if you do sell the car and you did have a loan on that car, there's a very, 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 very high chance that the car will be worth what you own on it. So it's just a little built-in, baked-in buffer that at all times, if you had to sell the car 3 years later, 2 years later, you know that if you had a loan, you sold the car, you don't have to have anything out of pocket. That's one of the reasons. The other reason is it can also slow you down with how much you spend on a car if you're a spender like me. So it's just a really kind of, again, just guide rails. When I say keep repayments less than 1% of gross income on a monthly basis, this is really just a high-level guide. We'll go back to the $150,000 income. You would not want each monthly repayment to be more than $1,500 across all cars in the household. If you had an $80,000 annual income and you're single, based on the 50% rule of $40,000, based on this monthly percentage rule and putting money in, you just would not want the monthly repayment to be more than $800 if your income is $80,000. So again, with all these big guardrails, it will just slow you down and make sure you don't spend too much on a car so you can then spend the rest of your money investing for the future. Here is an example of this rule in play. So the example is the household income is $150,000, which means, monthly repayments for both cars or stuff, but realistically, we don't want you to be borrowing for caravans or boats or motorbikes. It's $1,500. The first car they've got, it's a Mazda CX-7, and that costs $25,000, and that's what it's worth. And the second car needs replacing. So the maximum that they could kind of use into the second car is $50,000. Now, they want to get a Toyota Land Cruiser Prado, and I've just kind of looked online. There's one here that's $43,000 or $43,900. We'll assume that they got it for $42,000, which means they would need a deposit of around $8,400 based on this car here. And we'll assume that the $8,400 is the price of the car that they need to be sold. They're upgrading. So had to upgrade the car. They maybe sold it for 10 grand or whatever that is. They're going to put around $8,000 into the new car. So that means we need a loan of $33,600 over 4 years. Okay. I said before 15 to 20,000 Ks a year is probably okay. With a diesel Prado like this, that's, 20,000 a year on a diesel is totally reasonable and fine. So let's have a look at these two examples of monthly payments. This first one here, I think it was just a CBA car loan calculator. If we have a look here, the interest rate is 8.29%. But again, the interest rate, it's not the biggest part of the equation. It's literally the capital each month that you're paying is more of an issue. It's a secured car loan, so that's going to be $825 a month for this scenario. The interesting thing was, and this is why you have to say out loud that I don't want to do more than a 4-year term. When I opened this browser and the thing, it defaulted to a 7-year term. And this is where it can be the slippery slope. You go to the car yard, you get car fever. Oh, we really want that one. Oh, it's more. And they go, oh, that's okay. Well, if you can't afford the $200 a week, we can make it $142 per week, but make the term 7 years, and then you've got your car. Okay, so you've spent more on the car, and you just spread it out over longer. I need you to try and keep it to 4 years because we want this thing paid off and out of your life as soon as possible. If we did a split off the mortgage, for example, I just did a 6% interest rate. We're looking at $790, $789 a month versus $825. So look, it is a difference on a monthly basis, but again, it's not the mission critical. $30, $40 a month with a slightly higher interest rate. It does matter, but don't. And we'll talk about these 0% interest rates a bit later. It does matter, but it's not the driving force. It's like when people invest. Oh, I don't want to pay $5 for brokerage. I'm like, yeah, well, we want to keep our investing costs as low as possible. But let's not bury the lead here and say the primary objective is to invest as much money each month for as long as possible, and we'll pay a bit of brokerage along the way. The same with this car thing. We want to get a car that is reasonable based on these parameters and obviously pay the cheapest interest rate possible, but not leading with, we're going to buy a brand new and it's going to cost more, but it's 0% interest rate. Let's not kid ourselves. So just to recap, then I'll have a break and take a drink, and I'll come back and we'll continue the conversation with dealer finance and some other little hints. So the recap, anything in our financial life with motors that are toys, boats, caravans, motorbikes, cars, anything more than 50% of our gross household income. That's a good guide. It doesn't need to be new to be the safest. See if you can put a 20% deposit into the car. 4-year loan term, let's try and stick to that and keep all repayments less than 1% of your annual income on a monthly basis. Now, you're allowed to save up and buy a car with cash. You're allowed to do that. Even though you might have a mortgage, you might have equity in the house, you're allowed to save up and buy cash. I save up and spend cash on cars because I'm a spender, I turn my cars over fast, and I don't want a trail of payments. It is financially, quote unquote, better for me to probably get a car loan, because if my mortgage offset is 6% and a car loan can be the same interest rate, it makes sense that a car loan is probably better, but I'm just not pulling that thread. If I need to upgrade the car in the company because, sometimes I need to, if we've got events, I'll often drive to events and, run around and go to meetings and whatnot in the business. If I do need to upgrade the business vehicle, I think at this stage I'll still pay cash. Maybe I'll entertain a loan again, but I'm really not rushing out because it's the fastest way to get sucked up emotionally, go to a car yard, get a loan, and you have way too much car. So you are allowed to pay cash for cars and just get as little car you can in terms of cost. I know that the cars are expensive. There was a slide, I didn't mention it on the other slide. Generally, in terms of secondhand, Japanese cars are the way to go in terms of availability of parts, the quality of the build. They do hold their value a bit more, but you just want to spend as little as possible on a car. And if someone wants to save up and pay cash and they've got a mortgage and all that, they are allowed to. I will say as well, if you do have a mortgage and you did want to go to your broker and there was a legitimate need and we had to upgrade and we wanted to spend $50,000 and we're going to get a secondhand Prado or an Everest or Ranger or Hilux or whatever, insert car here, just get them to set up that mortgage as a second or third mortgage, so it's its own mortgage. And this is the issue. You will likely have that set up so the repayments are for 25 years, but you need to pay it down within 4 years, okay? Or if you've already got a mortgage and you've got money in the offset account, maybe, and this is where, I used to be a bit critical of car loans, and I haven't really had one since my business 8-9 years ago because, my car was basically my office and I ran it through there. Sometimes it's better to get the car loan, if you don't want to pay cash, and that's fine, but sometimes it is better to get the car loan even through the dealer or a secured car loan through your bank, have that on the 4-year term, than doing the mortgage redraw or the mortgage money out of the offset, or even setting up another mortgage, because at least you know that it will get paid down within 4 years, and that's out there. So we'll take a break. When we come back, I'm going to talk more about this deal of finance and some other things. And we might even do a part 2 episode, and I'll answer all your car questions. So if you are watching this on YouTube, put any questions in the comments, and I'll also ask on the Facebook group for car questions, because we'll do a part 2 to this episode. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.